Okay, here I am in my SynchroStream platform, and just to show you the difference between just shorting a call option and shorting the outright, just to clearly show that it is less risky selling a naked call than just shorting the outright. So the price right now of natural gas is around 430, around this price. So if we short this is a simulated trade basically. So if we short the outright future right now and we get a 20% move to the upside, we'll be losing around $8,000. You can see right here the amount we'll be losing at this price point. Also, it's important to note how much buying power we'll be using for just one contract. We'll be using $11,000. Those limits were increased, but it's good to show it just as an example, so that we can compare it later on. Okay, so let's see. Again, we were losing over $8,000 in this trade with this type of move. So if we did at the money call, this is an at the money call at the 4.3 strike, and we get the same move, we see that if we did get this move today, we'll be losing around $5,000, and at expiration we'll be losing around almost 4,000, like 3,800 basically. You can see right here when I put the mouse over. So just right at the bat, you can see how just trading naked call is a lot safer. But how about if we compare it with buying a put or a spread, right? So let's do the same example. Now we are long a put. These all are of course short trades. We want the price. This is the price of the stock, of the future in this example. We want it to go down, so we make money as long as the price go down. And when we buy options, we don't start making money after the price moves enough of or more than what we already paid. So if we get the same 20% move up, we'll be losing at that time around almost $3,000 too. But at expiration, which is the blue line, will be almost $5,000. So $4,800. Again, is also less risky than selling short the outright. The problem with this is the probabilities are much less than doing the naked call. So for example, if we want to see the probabilities of making money in this trade, you can check it out. We'll be losing 60% of the time. We'll be losing, and almost 40% of the time is where we're gonna be making money. For example, if we do the same thing in doing the short call, the break-evens will be the other way around. We'll be making money 70% of the time and losing 30% of the time. But the caveat is that our winnings are gonna be capped if we sell the call. So our maximum win will be $4,700, and in the put we have unlimited upside but unlimited downside. So that's the difference mainly, right? So in theory it sounds really good, but how many times it goes all the way where you gonna make unlimited profit? So let's do another example. Now let's do again the 20% and move this back to where the price is, so it's easy to see. And what about vertical, right? Instead of this long put, if we do a vertical, just one, our max loss is gonna be only $1,000, right? Like $1,300, and at that price we'll be losing like $500, and at expiration again $1,300. It will be our max loss, and our max win of course is gonna be just $600 because we're risking a lot less, right? But this is not, we're not comparing apples to apples. So let's see if we can make it more of a normal kind of trade. If we go and change it, looking at our buying power, right? How much we're using in terms of capital. One future chart will be using around $11,000, and this is theoretical, and of course each broker can change the capital requirements. They can increase X amount above the CME limits. So this is what Synchrosync is doing, but we're still gonna use it just for as an example. So if we're gonna use $11,000, let's do the same exercise using that as a kind of as a bar, right? So now, if we want to use that same amount at entry, around $11,000, for the naked call, we'll have to move a little bit out of the money. So now, instead of at the money, we're out of the money, so our probability of making money is higher right now. We can check it in this kind of trade. Will be 76% chance we'll be making money. So that of course is really nice, but right now we just want to see how much we'll be losing on a 20% move to the upside. If we get a 20% move to the upside, we'll be losing around $4,000, almost $5,000. And at expiration, we'll be losing only $600 at expiration. So if we compare it with a put, now we will have to buy 2 puts so that our capital requirement will be around $11,000. So that will be our max loss will be $11,000. And if we get that same 20% move, at that time we'll be losing around 6,000, but at expiration we'll be getting a max loss of $11,000. And on a vertical, again, we'll have to increase the number of contracts, and I will be having 8 contracts. And with the same move, again, we'll be losing 4,000, but at expiration, $11,000. So again, they are all the same trades in terms of the direction we want the price to go down. And if we get a 20% move to the upside, definitely the naked call will be the less risky, right? And even though we're losing at that point $5,000 or more, because the volatility may increase, or most likely will, you could just roll and keep extending time until the price go back a little bit, or you can even do more things in terms of defense. Things that at expiration we'll be losing only $500 in comparison to the original $8,000 on the future, and the full loss of buying an option that will be $11,000. So hopefully that is something that it can show a little bit a clear picture of how option works and why it is actually better to trade naked options than just the outright. It's safer actually. The key part is that you have to manage your buying power. So let's go back again. So this is the same call, right? So right now at entry, the buying power we were using was around $11,000, but once we get this move, you can see that almost double up. Our buying power was double, around almost $20,000. So that's the key part of knowing you have to be aware how that works and how to manage your buying power so that it doesn't happen a margin call, and then you have to close a position. Maybe you're over here losing, but you still inside your break-even point, but you still have to close it because of a margin call. So that's why it's so important to keep your trade size small, so that you can defend and you can, even get this kind of hit in terms of the buying power expansion or the capital expansion. If you compare it in terms of a debit or a long, it's going to be the same buying power, because it's basically your max loss is going to be the maximum buying power that we'll be using. So hopefully that clears things up. And if you have any questions, you can just write down on the comments. And if you like this video, you can like it, share it. And if you like me to do more of this kind of videos, just subscribe and let me know. Thank you.